What is an IPO? IPO, Initial Public Offering. That is what we are going to be breaking down in depth in this video. This is day 10 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people receive in their entire life. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's get right into the video. So, what is an IPO, or Initial Public Offering? Well, in essence, an IPO is the process in which a company goes through to become public. But a private company doesn't have to go through an IPO to become public, although very few companies skip this step. So an IPO is basically an event where companies sell shares to the general public to raise capital for the first time. Prior to an IPO, a company is basically owned by its founders and its investors. By going public, a company can raise additional capital to fund growth and expansion, as well as provide liquidity for founders and early investors to sell their shares if they'd like. And a big misconception: companies aren't always selling stock. What I mean by that is an IPO happens. The company makes money from that IPO, but then those shares are traded back and forth between investors. But the company only raises capital that initial first time. Now, it can go on to issue further shares, of course, but it's not constantly making money anytime shares are bought or sold on the market. Now that we got that cleared up, how does an IPO even work? The IPO process usually begins with a company selecting a bank or investment firm to serve as the underwriter of the offering. The underwriter will help determine the appropriate price range for those shares. And in a lot of times, it'll also market the upcoming IPO. The company will then set the final selling price for the IPO and it will launch. Once the IPO happens, these shares begin trading on a public stock exchange, like the New York Stock Exchange or the NASDAQ. So what does this all mean for you if you come across an IPO and wish to trade it on opening day? Well, first and foremost, make sure that you know the following: the company's revenue and profit growth rates, the company's competitive position in the market, the strength and experience of the management team, and of course, the potential risks facing the business. Remember, when a company goes public, so do its financials. So use this new public information to make your decision. Also, be aware that IPOs can be extremely volatile, and prices can fluctuate violently within the first few days to weeks. The best thing that you can do is to not fall into the FOMO that surrounds most IPOs. And then analyze the company for what it is and compare that value to the price of the stock, as you would with any other company using fundamental analysis. And yes, on Monday's video, we are going to be discussing what fundamental analysis is and how to use it. So make sure to subscribe and hit the bell notification if you haven't already. These next few lessons are going to be good. And this is when we start getting into some topics that you can directly use to make money as we continue our journey of 100 Days of Finance. I hope this video was fun, easy to watch, and informative. Again, my name is Derek and I got my degree in finance, so you don't have to. I love this stuff. It's been my passion for over a decade and I love to be able to share that with you. So I will see you in Monday's video.